Alright, thank you so much for joining this video. We're going to talk about accounting and understand the principles and basics of accounting. Alright, let's jump right in. So let's understand why learn accounting. Accounting principles and basics are key to understanding a business. Now, most people, especially in today's day and age, like to become entrepreneurs, and especially since it's a very coveted profession, people are starting to look at entrepreneurship as something they'd like to do after college. And even we're looking at a trend of people not going to college but starting to be entrepreneurs very early. Now, because of this and because of people jumping right in, there is a very big failure rate in early and mid-stage startups and entrepreneurs, primarily because of operating a business without the financial understanding and backing. Now, entrepreneurs are also figuring that they can just go ahead and hire an accountant and everything's going to be okay. But that's not really true, is it? Because it's very easy to be taken advantage of, and it's also very easy to overlook certain facts, especially when you don't have that understanding. So, coming back to the real question, accounting is important because it gives you a complete perspective on financial understanding, so you can go ahead and operate a business such that your business, either today or in the near future, if it is on the brink of failure, you can look at the data and statistics in front of you to be able to understand how to turn that business around, where you're losing money, what is your most profitable product or vertical that you can focus on, and give you a better sense of how to really manage things. What you'll also learn in this series is the depreciation of assets and how things are valued, such that tomorrow if you're looking to go ahead and invest on something, it's important for you to understand how assets were depreciated, thereby what is the net income that's declared and what's the difference between the gross revenue and the net operating income that's finally left over. So just a few key terms that we'll go over in the beginning, and we'll also go over complete understanding of finance, such as to get better in business. Let's look at the definition of accounting from Investopedia. First thing, accounting is a process that includes summarizing, analyzing, and reporting. Now, it's also the process of recording financial transactions pertaining to a business. But why they say summarize, analyze, and report is that you're actually going to put together all the financial information into one document that makes it easy for you to read that information, get an idea of the financial health or how the company is doing, analyze that information, and then report those transactions. So basically it helps you get a complete clear picture of the financial summary of the business, and that's what accounting is. It's not there was transaction A on day 1, there was transaction B on day 2. That is a part of accounting, but it's also about going ahead and seeing and analyzing the data and figuring out how to improve certain metrics so you can drive revenue and increase the net income. Now, before we jump into looking at accounting equations, just have a look at GAAP, which is generally accepted accounting principles, and also IFRS, which is International Financial Reporting Standards. The reason that both of this coexist and you're looking at accounting standards improve year on year is because of technology, the world is becoming smaller, people are getting more connected, and transactions are happening worldwide. Imagine today you can look at buying something on Amazon USA by being located in France and get that product imported into France. Such transactions never happened a couple of years back, but they're now happening because of the power of the internet. Hence, to make things easy on an international level, we have the IFRS and the GAAP to help improve accounting standards. So let's jump right in. Alright, now let's first understand accounting principles. Okay, by that we mean this simple formula: assets equals liabilities plus owner's equity. just this one equation is enough for you to understand the basics of how to structure accounting. Quick look at an asset. An asset is anything that is of value. Companies buy assets, and typically if you'd like to understand what assets a company has, you can look at their balance sheet to understand how much, and read their annual reports and look at any news from the company, stay updated to look at exactly what assets they own. So you will see a breakdown in the asset column in current and non-current assets. So current assets are anything that can be liquidated within 1 year, which means they can be converted into cash within 1 year. And non-current assets are assets that take more time, something more difficult to liquidate. Property, plant, equipment, these can be considered non-current assets. Next, let's look at what is a liability. Liability is something that a business owes or a person would owe to somebody, usually a sum of money. They are settled over time or maybe settled at the time of settlement in case of maybe credit card debt, and there's a debt collection agency that involved and they're looking for settlement. So either ways, liabilities are settled. Now, looking at where they're recorded, they're usually recorded on the right side of the balance sheet. They include loans, any accounts payable, mortgages, deferred revenues, earned premiums, unearned premiums, or any accrued expenses. So let's actually take a deeper look into this. So let's quickly take an example. Let's start with a sum of $500, right? So let's say you and your friend, let's call you A, let's call your friend B. Now, your friend B borrows $500 from A, which would be you. And at this point, he says, I will pay you back in about 2 to 3 months, right? Now, in your books, that becomes an accounts receivable, all right? So remember that, accounts receivable. We'll make that bold. Now, typically, what happens in this case is when it is an accounts receivable, it is an asset for one person and a liability for another person. So in this case, B is the person that owes the money, and A is the person that lent the money. So in this case, for A, that is an asset of $500 as an accounts receivable, right? And for B, it would be a liability because B owes $500 to A. Now let's make it simple and summarize. An asset is what you own. A liability is what you have to pay. What you own and what you have to pay. Alright guys, thank you so much for watching this video. The next video is going to be about owner's equity. If you like this video, please go ahead and hit the subscribe button. It would really support the channel and help boost rankings with the YouTube algorithm. Thank you for watching.